The 15% drop in average stock prices during the past month has galvanized a growing number of bears to once more dig out ancient textbook reasons for why this is the time for the stocks bear market to finally begin. And not only that, but keep making definitive statements for their expectations for market crashes that always fail to materialize, for the obvious reason that a crash is a panic event that can only at best be discerned no earlier than during the preceding day. Even then, the probability would favour the market ending higher on the so-called crash day, because market crashes are not common events that can be predicted. Nevertheless, the hefty stock market decline is providing ample ammunition for the bears to successfully convince an increasing number of retail spectators, through a myriad of reasons such as falling corporate profits, shrinking balance sheets, rising debt mountains, deflation, and the Fed ending QE, and of course the prospects for an imminent rise in US interest rates, and even Europe's refugee crisis is apparently a harbinger for a long awaited for mother of all stocks bear markets to begin. This despite having missed the bull run of the past 6 years. During the past few weeks, the stock market has been showing significant deviation from my forecast trend for 2015. Hence this updated analysis that will seek to reappraise the prospects for the Dow Stocks Index for the remainder of 2015. China's stock market meltdown that began mid-June from a SAC trading high of 5,200 had paused under the weight of heavy Chinese government interventions that in total amount to over $400 billion thrown at the stock market in an attempt to bring the selling to a halt. However, all of that literally went up in smoke, along with one of China's largest ports which literally exploded, revealing behind the truth of what the Chinese economy is, merely a mirage of the picture of strength and stability that Communist Party propaganda has been successfully propagating. My recent update for the long-standing prospects for the Chinese stock market reiterated expectations for a spike low to approximately 2,500 before the Chinese stocks bull market once more resumed, towards levels that are unimaginable today, i.e. that a decade from now the Chinese stocks index could triple from its recent low. In terms of the immediate future, continuing weak Chinese stock trending towards a final low will act as a drag on Western stock markets, which implies the likes of the Dow will be kept under pressure going into mid-October or so. Crude oil. My last in-depth analysis focused on the prospects for the crude oil price into mid-2016 and concluded in a trading range forecast of between $64 and $40. The overall picture is one of substantially increasing supply coupled with slowing demand that will remain a net positive for most US stocks for 2015, especially those reliant on energy costs such as the airlines and transportation companies. Conversely, those sectors reliant on high oil prices will suffer, such as the oil exploration and drilling services companies. The stock oil price graph clearly illustrates an overall inverse relationship between oil and general stock prices. That is, as long as GDP is growing and not contracting, i.e. a recession. So despite at least some negative blowback from a weak Eurozone, slowing China and the suffering oil sector, overall a low oil price should boost the US economy and stock market. So after the market has fully come to terms with the ongoing collapse in oil prices, then the stock market should resolve to a bullish trend. US dollar. My in-depth US dollar analysis of mid-December 2014 concluded in the following trend forecast for 2015 to converge towards a peak in the US dollar by August 2015 of a spike to just above US dollar 100 before retreating towards 92 by the end of the year. The Dow USD chart illustrates that a strong US dollar tends to act as a dampener on stock market trend, where a persistent trend for rising US dollar acts to slowly erode bullish sentiment over time. So the impact is gradual rather than immediate, which means that there can be a delay in stock market reaction to US dollar strength of several months, which can end up confusing many analysts who fail to realize that there is a lag. As my long-standing forecast is for the US dollar weakness from August into the end of the year, a trend that is coming to pass, then this should be supportive of the stock market. However, it could take a couple of months for such a positive influence to become manifest as the stock market travels through the choppy months of September and October. But thereafter, I would expect the stock market to react strongly to the continuing dollar weakness during November and December that could prove to be strong months for stocks. US interest rates. For the whole of 2015, there has been a building expectations for the Fed to raise interest rates that had focused on September being the month. However, now that September is actually here, the question to be asked is, will the Fed finally pull the trigger, or will they err on the side of caution and delay for another month or maybe two? In my opinion, whether the Fed raises or not this month does not really matter too much at this stage, because it will be just a token move of raising rates from 0.25% to 0.5%, rather than signaling a series of monthly rate hikes in a row. In fact, stocks and housing are more likely to rise during a rate hiking cycle and fall during a rate cutting cycle, which is the exact opposite of the consensus view, which is common sense because interest rates are cut in times of economic weakness, recession or financial panics, whilst interest rates are raised to cool an overheating booming economy or in response to an inflation panic, neither of which is taking place today, with the US CPI inflation of just 0.2% and GDP growth of just 2.5%. So in economic terms, the case for significantly raising rates is just not there. The bond market price action confirmed expectations for a rising trend in interest rates, which therefore employs erosion of bond prices, which I'm sure the Fed wants to happen in an orderly manner rather than panic selling. Hence again confirming expectations for a very gradual process for raising interest rates so as not to spook bondholders into a panic rush for their exit. Where stocks are concerned, the early years of a rate hiking cycle tend to be bullish for stock prices, for the interest rate rises tend to take place in a climate of economic strength and not weakness. Instead, it is interest rate cuts that bulls usually need to fear, for they signal weakness ahead, as was the case during 2008 and into mid-2009. Moving averages. Not only has the Dow broken below its 200-day moving average, but that the 200-day and 50-day have crossed a death cross, which is a major bearish signal. At best, this suggests that the Dow is going to find it very difficult to make a new all-time high this year. In fact, the Dow may even find it difficult to sustain a rally above 17k, especially as the 200-day average will act as resistance. On the other hand, the worst case scenario is that the death cross has heralded an end to the stock's bull market. However, on a positive note, the death crosses are not very reliable, i.e. statistically, less than 40% probability for success, so ironically can prove to be a good contrary indicator. Elliot Waves. My original Elliot Wave expectations were for a rally into summer 2015 to be followed by a significant ABC type correction pattern. The updated chart shows that the wave pattern as it unfolded during the year, including the recent C wave spike low, that should mark the end of the correction, and thus herald an impulse trend higher where the wave count could number as many as 9 waves by mid-2016. i.e. Elliot Wave implies that the stock market is about to enter a strong bull run that could easily last another 7 to 9 months, and therefore a series of new all-time highs are likely. Dow Channels. Dow's 3 upper channels have managed to contain most of the Dow's price action for the past 3 years, where the Dow repeatedly targets highs at the top of channel 1 and correction lows at channel 2 and 3. That is until this year's summer correction broke the trend channel pattern. The new channel from the recent low is expected to contain the price action, or if it fails, then it would confirm that an already weakened stocks bull market is showing serious signs of ending. Therefore, for the bull market to continue, the Dow should not revisit the recent low, and any expected weakness over the next few weeks be supported by the rising trend channel, whilst any rally can be expected to be weak and not make it back to channel 3 for at least the remainder of this year, which implies a price cap of around Dow 18k. Trend analysis. The Dow has sliced through a series of trend lines and support levels that have damaged the bull cause. Having bounced off support at 15,350, which was a relatively minor previous low, means that the Dow could revisit the low and even break it to target firmer support at 14,700. So in terms of trend analysis, the Dow is not looking very healthy, with plenty of overhead resistance and weak underlying support that could result in another leg lower towards Dow 14,700. At best, the Dow could spend some time, perhaps as long as a couple of months, between 15,400 and 17k as the Dow tries to improve its technical picture in advance of a next leg higher. Stock market volatility. VIX. The VIX chart illustrates the strength of the current stock market correction that far surpasses anything of the past 3 years. So it's not surprising that it's generated so much bearish commentary. However, the VIX chart also shows that volatility has already fallen by more than 50% from its recent peak, which is bullish for the stocks going forward, as the volatile correction has done a good job of dissipating the built up bullish consensus to bring the market towards a 50-50 knife edge, which is what one wants for a sustained bull run. Therefore, the VIX is supportive of my view that the stock market is setting itself up for a major bullish rally, not only into the end of 2015, but well into 2016. The VIX is also signaling to expect more volatile trend going forward, i.e. wider swings and more severe intraday spikes. Pulling all of this analysis together, then my final conclusion is for a continuing weakness that will result in a volatile trading range with a probable retest of the recent low of 15,370 by mid-October. That will set the scene for a strong rally into the end of the year that could see the Dow trade above 18k before targeting again for a 7th year in a row at above Dow 17,823. So ensure you are subscribed to this YouTube channel for new in-depth analysis and concluding trend forecasts.